Hello, I'm Stephen from Triphylium Economics and Financial Accounting Tutoring TEFAT in Sydney, and today I'd like to give a presentation on traditional double entry bookkeeping with General Journal and General Ledger. So double entry bookkeeping used to be done in books, with one book for the General Journal and another book for the General Ledger, and it was all kept manually and written in manually without the use of computers and accounting software which came later. So the first manual was put forward in northern Italy by Luca Puccioli, Arithmetic, Geometry and Proportionate, in the Middle Ages in 1494, and another northern Italian, Martian Manicus in Florence, worked for Olfi, 1299 to 1300. So double entry bookkeeping developed it in the 14th century and 15th century in northern Italy with the merchants who traded from ports such as Venice. So accounting software didn't go in till 1978. Visi Carli from Wikipedia, the source, 29th of the 9th, 21. Then Peachtree. And in 1998, QuickBooks was commercialised, and you had other accounting software such as MyOb and Xero later. So you start from posting in the General Journal first a debit and a credit in a transaction with the date, a description in the General Journal, and then those figures are posted to General Ledger, which is a T-shaped account. It doesn't have to be T-shaped. Sometimes they're just put in columns. It depends how the author of a textbook or resource arranges it. But in each transaction there's a debit and a credit. Now, debit and credit items on the financial statement, and these figures are posted to the financial statements. In a balance sheet, all your assets are debits, all your liabilities are credits, and your net assets capital is a credit item. That's the balance sheet. On the profit and loss, the P&L, sales or income is a credit item, and expenses below that sorry, did I say, income is a credit item. I'm sure I said that. And expenses are always a debit item in the P&L below the income. So in the P&L, income minus expenses equals net profit. So you're going to have to get used to which are debits and which are credit items to succeed in this. So there is a bit of memory work at the start for the rookie bookkeeper, accounting student, that you have to really memorize and be familiar with these General Journal entries, because they don't vary. They never vary. The debit is always the debit, the credit is always the credit, and these general accepted accounting principles always remain in place in the accounting field. So you have to be very familiar and accurate with these transactions. So with General Journal, you just put the company at the top. Say it's company XYZ, and you really should do it for the ledgers as well. I didn't, because these whiteboards are limited room. Then you've got the year on the top, the year 2021, and so the date is on the left hand side. For example, March the 1st, March the 15th. The transaction is a description below both the debit and the credit, That's the numeric monetary value of the debit and credit. So we'll start off with the first transaction, pay a stationary expense by cash. So it's a cash payment. So you've got the debit is stationary expense of 130 and bank is 130 credit. With bank's a good guide because outgoing payments are always a credit, incoming receipts are always a debit item with bank or cash. So as I mentioned, paying a stationary expense by cash, the debit is stationary expense 130, the credit item is bank 130, outgoing cash to pay for the stationary expense. The second transaction is pay accounts payable to other parties you deal with. So with accounts payable, the first transaction is always accounts payable is always a credit item on the balance sheet. So the debit is a purchase, the credit is accounts payable. But so that's kind of like a short-term loan to another company. But in this case, you've actually paid back some of that money owing to the other company. So when that happens, you buy, for example, buy stock on credit. You credit the accounts payable, A/P in short, and you debit expenses, okay? And also inventory has got another entry which I'll get to later where inventory interacts with COGS to either increase inventory or decrease inventory. But just a summary of this transaction, buying some stock on credit. You debit the expenses always a debit item, and you credit accounts payable. Okay, so you owe money for that stock which has to be paid to the company in a later time. That's another transaction. So that was March the 17th. On March the 19th, the company sold some stock on credit to other companies. They sold some of their stock. So you debit accounts receivable, which is a current asset in the balance sheet. 500 is this example, and you credit credit sales, okay, $500. So debit and credit. On March the 25th, on March the 21st rather, sorry, my phone just went off, probably a spammer. There was a cash sale of the stock. This time it wasn't a credit sale, it was they just received cash and put it in their cash register for some stock they were selling a customer. So there's incoming cash, debit the bank and credit the sales. The sales is a credit item on the P&L. So I've put some more journal entries in this whiteboard on the left hand side on the same year, 2021, some transactions in March the 23rd. The company received cash in their accounts receivable account. So you debit the incoming cash $75 and you reduce the accounts receivable $75 because accounts receivable is like your short-term loan to your customers for credit sales, but when people actually pay the money, you debit the bank and reduce the accounts receivable. That was on March the 23rd. March the 29th, the company purchased a machine by cash. So outgoing cash, immediately bank credit and debit for the machine, the asset of $500. Machines sit in non-current assets in the balance sheet. So that's that transaction. On March the 30th, the owner withdrew some drawings from owner's equity on the balance sheet. The owner took some drawings from the company for personal expenses such as fuel, rent, their groceries. So for the company's point of view, even though the money goes to the owner, from the company's point of view, and the company is at arm's length to the person running the company, to the director or the owner, or so on. From the company's point of view, it's a credit item of $1,700 bank and debit drawing $1,700. And now this transaction, some inventory sold. This is what I was talking about before, how you might have bought some stock, but this transaction still has to be done. So inventory sold means you've reduced inventory. That's a credit item now, $470, and COGS, cost of goods sold, is $470. What COGS is, it sits directly below sales. It's the cost of sales. It's the cost of buying inventory. So you've got opening stock, purchases of inventory, goods available for sale, less closing stock after the audit if it's a manual audit, or perpetual inventory if the computer records the inventory changes. So COGS sits below sales in the P&L. Sales minus COGS equals gross profit, and then other expenses sit below gross profit, which I'll get to in another presentation on the P&L. On March the 31st, the last day of the month, capital was added to the business, quite substantial capital too. $50,000 went in to the bank by perhaps a partner, if it was a partnership, and capital, always a credit item on the balance sheet. Net assets is $50,000 too. Perhaps I was missing a digit here. That looks like it's only 5,000. And if you're running out of room, just put K as short term, 50K, $50,000. So the partner introduced some capital to the business. $50,000 went to the bank, debit item, the firm's bank account, and capital was increased. Capital is always a credit item, and we increased capital by $50,000. So that's the general journal, okay, outlining the transaction, the debit and the credit, the date, a brief description of the transaction, and now these figures have to be posted to what's called the general ledger now. And in the old days, in the 1920s and 30s, since the Middle Ages, these items were just written in books, the ledgers. So I'll have to keep flipping over the whiteboard because that's how I'm doing this. So back to this transaction in General Journal, we've got debit, a stationery expense of $130, credit bank. So with this, when you post it to the general ledger, you just keep to the debit and the credit, but you label it the opposite thing. So debit, stationery expense. Expense is always a debit. That's okay. So $130 they bought at the local stationery shop. So if we're going to debit stationery expense, we go to debit expense ledger. But that's not labelled expenses here. It's labelled the opposite part of the transaction, which is bank. And similarly, you pay with cash, credit, bank, outgoing cash. You go to bank, bank or cash. Its title. Where's bank? Oh, here it is. So on the credit side, you label it stationery expenses, and that's consistent because outgoing cash is a credit item. So that's okay. That's the first one, and you just keep doing this until you've gone through all the transactions. So the next transaction, we said for paying accounts payable to other people, we debit accounts payable. Remember, accounts payable is usually a credit item, but we're actually reducing accounts payable because we're paying out on our little short-term loan to the other company. So debit accounts payable, 150. Debit accounts payable, here it is. Debit accounts payable, 150, but label it the other thing, bank 150, and with bank you pay the accounts payable account 150, okay? Again, that's consistent. Outgoing cash as a credit item. Next transaction, it's buy stock on credit. So we increase accounts payable by $90. That's a credit item. We debit expenses, and $90 was the value of the transaction. So first go to expenses again. Expenses 90. There it is. Label it the opposite part of the transaction. Accounts payable 90. And what was the other part of the transaction here? We said credit accounts payable. Okay, yep, that sounds logical to me. So credit accounts payable, where's accounts payable? Here it is, and label it the opposite part of the transaction. So expenses $90 on that, the credit side of the accounts payable account. Next transaction, we said the company sold some stock on credit, so we increase accounts receivable by 500, and we credit sales 500. So go to accounts receivable, go to the accounts receivable ledger, $500. Accounts receivable, yep. So label it the opposite thing. Sales is 500, and the other part of the transaction was credit sales 500. So go to credit sales. Where are credit sales? Where are credit sales? That's cash sales. Oh, here, credit sales. So label it the opposite thing. Accounts receivable $500 to complete that posting. And the final transaction on this whiteboard, a cash sale of stock. So money going into us. So we increased bank, $70. There's the cash sale, $70, label it the opposite thing. And with cash sales, just here, it's bank, $70, okay, label it the opposite thing. So we've received the money, it's a debit, that's consistent. The credit is over here in the cash sales ledger, other part of the transaction. So that completes those. A few more journal transactions. Usually get about 10 or 12 in an exam situation or an assignment. March the 23rd, the company received cash in the accounts receivable account, so you reduce the accounts receivable account credit. Credit accounts receivable 75, debit bank. And so posting it, first you go to bank, we're looking for 75, and label it the opposite thing, accounts receivable 75, go to accounts receivable, and credit accounts receivable, reduce it, and label it bank, 75. Next one, the company purchased a machine by cash, spent $500 for it. You increase the assets, machine, $500. You credit bank outgoing money to buy the machine. So let's go to machine, which is an asset, label it bank 500. Machine's always a debit item, that's consistent. And with bank, you credit $500. That's outgoing money, credit bank for the machine, okay? Next transaction, March the 30th. The owner took out some drawings for his or her personal expense. So you debit drawings $1,700, that the owner needed $1,700 to pay for things like fuel and electricity, credit bank. So drawings, we're looking for drawings. Bank $1,700. And with bank or cash on the credit side, outgoing cash for the company, drawing $1,700, labelling it the opposite thing again. I sound a bit repetitive, but students have problems with this double entry bookkeeping concept. So it's just practice. That's just practice. And some inventory sold. COGS is increased. So in inventory sold and COGS is reduced rather, because it's usually a credit item. It's a type of expense. And inventory was reduced, credit, because inventory is usually a debit, but when you sell inventory, you got to reduce it, so you got to credit it. So let's look for inventory, credit, on the credit side. Inventory, label it COGS 470, and with COGS on the debit side, inventory 470. Remember, COGS on the debit side, COGS is usually a debit item, and so with the P&L, sales is credit, expenses a debit, and I may have just made a bit of an error with just describing it, but I'll override that now. I'll just say that COGS is a type of expense in the P&L, so it's a debit item, and sales is an income. But this time around we're matching in the transaction, we're saying inventory sold, we're reducing inventory a credit, which we already mentioned. Oh, I forgot to post that too. Inventory sold, so COGS 470, yep. And other part of the transaction, you increase COGS, debit 470, label it inventory, that transaction's completed. So yeah, what I'm trying to say to you is COGS is a type of expense in the P&L. It sits below sales. Sales minus COGS equals gross profit. COGS a type of expense, debit item. And final transaction in this sequence, some capital added to the business, quite substantial capital of $50,000. A partner may have added to the partnership. So bank increases $50,000. Label it opposite thing, capital $50K, and with capital, bank $50K. And capital is always a credit item, so that's consistent. So then what you got to do, that's not finished just yet, you've got to add up all your debits and credits and get a total for both sides of the ledger, the debit side and the credit. So debits usually equals credits, but not always. Accumulated depreciation is always a credit item. Not many debits unless there's been a posting error or something like that, or an error with depreciation that has to be rectified in the depreciation schedule. But usually debits equals credits. If they aren't, find the difference and label it closing balance. And the closing balance for that month or quarter or half year or year gets posted to the next month or the next quarter or the next half year or the next year as opening balance for the same account for the next period. So again, add up all your debits, find the total debits, find the total credits. Debits usually equals credits, not always. If debits don't equal credits, find the difference and carry it forward either on the debit side if the difference is on the debit side, or the credit side if the difference in numbers is on the credit side. And that becomes opening balance for the new period. So closing balance in this period is balance carried forward, and opening balance in the next period is balance carried down from the last period, whether it's the last month or the quarter. So I'll give an example of adding up our transactions that we've just done for the bank. So this bank ledger is exactly the same in our example. Just check the video recorder. Yep. So we've got all our debits here. Cash sales $70, accounts receivable $75, capital $50,000. That was quite substantial. On the credit side of bank, we had stationery expenses. We paid outgoing cash. We paid settled some accounts payable $150. We bought a machine for $500. We paid the owner drawings and the company $1,700. So obviously here debits aren't going to equal credits because of that capital item. So when you add it up, it's $50,145. On the credit side, it was $2,480. Now alarm bells might be ringing here. You're thinking that's a major error or something, but you find the difference. It isn't. You find the difference, and that becomes closing balance for $47,665. The difference between those two figures. That figure becomes balance brought forward in the next period of bank for April. So we could just make a little note here, April. That's the next month after March. Also, reconcile your figures on your financial calculator back to zero. So checking so there's no arithmetic errors or subtraction errors or division or multiplication. If you're using multiplication and division, always check it twice on your calculator to reconcile your figures so you haven't made an error there. Error of principle, say a wrong posting could be -2 marks, but an addition error would be -1. So that bank is sort of like a mini trial balance just for that account. A trial balance is adding up the debits and credits for all the chart of accounts, and then those closing figures are posted to the financial statements then after the trial balance. So that figure would effectively be in the balance sheet in current assets, the closing figure. So subsidiary ledgers is another term. Now with the sales journal, the payments journal for big companies, for example Coca-Cola Amatil, their sales journal is so huge, selling to different customers, that they need subsidiary ledgers. They need to divide up all those individual customers into separate subsidiary ledgers, yet all those customers are still part of the sales journal, but you just add up all the little subsidiary ledgers for each customer. Similarly, these companies are so big with cash payments, they have to divide up their payments journal with all their individual customers with separate subsidiary ledgers. But those separate subsidiary ledgers are still part of the payments journal, and that closing figure of payments is posted to the financial statement. So is sales in the income statement or P&L. So that's the definition for subsidiary ledger. It's just efficiency, efficacy. ease of identification of one customer. So I hope this presentation you found useful. I'm Stephen from TEFAT in Sydney. This is actually my first bookkeeping presentation. I will be presenting some others, and to date I've done some economics one both at school and uni, so now I'm on to economics. I'll be doing one in the very near future on the profit and loss statement, balance sheet, cash flow statement, balance day adjustments, just to memory. So thanks so much for viewing this, and bye.